This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are pleased to welcome on John Ensley with J-Ensley Financial. And we're going to be taking a little bit of a departure from the normal content that we cover, which has a lot of flavor on alternative investments within retirement plans and IRAs, but still being able to bring you valuable content and how you can utilize other avenues of capital generation to invest in. And I always hate to kind of coin real estate as an alternative asset. I mean, heck, the Romans saw value in real estate, and they weren't buying Microsoft and IBM. So again, I like to, bring a well-rounded viewpoint of personal finance and investing in things that are outside the stock market on this podcast. So John, thank you very much for being with us on here today. Give us a little bit of background about yourself and kind of how you came to be in the market that you are, dealing with insurance and different avenues that people may not necessarily be familiar with.
Thanks, Alex. I'm super excited to be here. Thanks for having me. So my story really kind of begins in the mid to late 90s. I was working with a company that had an employee stock ownership plan. And if anyone remembers the late 90s, that was the build up to the tech bubble was expanding. And so we were going to do an IPO. It was super exciting. Everyone was going to be, rich beyond our wildest dreams. And then, of course, the bubble burst. So the IPO never happened. Everything kind of fizzled. And when I left that company, I did have a little money left in that ESOP plan. And I did some calculation at that point and realized that I was going to be exposed to some pretty serious taxation later on if I didn't do something different. And so I looked for an alternative and decided that I bought a property in Washington State and started developing this little subdivision, 5-lot subdivision. And the plan was to build spec homes on each of these lots. And if you remember the mid-2000s, the build-up as the real estate bubble was expanding. So, of course, I had as-if appraisals that made this project look like it was just going to be amazing. We were going to hit it out of the park. I was about maybe halfway through building the first spec home on the first subdivided lot in 2008. And things started going south at that point. And I made some big mistakes. I borrowed some money, tried to save the project, tried to keep it going, and in the end, it failed spectacularly during the 2008 to 2009 crash. And so that I'm grateful for that experience today, even though those were some pretty dark days for me personally, because it was a wake-up call, and it got me to start studying and learning and absorbing all the information that I could absorb. And learning some things about the financial system and about real estate and about how some of these things are working. And it really woke me up to how ignorant I was of so many things before this, right? And so during that period of time, I was on a webinar one evening on one of the things I was following. And this advisor was walking through this example. He had a couple and a home and their home equity. And then he started talking about a cash value life insurance policy and how that was building equity simultaneously. And he mapped this whole thing out. And at the time, I really kind of hated the idea of life insurance. I hated the idea of being worth more dead than alive, that kind of thing. A lot of people have that feeling. But it was the first exposure I had that a cash value life insurance policy could be something other than a death benefit. And so that intrigued me. And I went down kind of that path and started studying more and learning more. And somewhere during that webinar, he uttered the words bank on yourself or infinite banking. And so that led me to some resources that explain what that was. So ultimately, I wound up setting up a policy that they described in those concepts, and just got very passionate about that whole idea. I had been to many, many financial advisors over the years, and nobody had ever shared anything remotely similar to this concept of using high cash value, low commission, dividend paying whole life insurance as a platform for wealth building. So after using my policy for a couple of years, I got pretty excited and I was kind of ready for a career change. So I got licensed and for insurance and completed some training programs, both through the Infinite Banking folks and through the Bank on Yourself agent training program. And I launched my practice, J-Ensley Financial, in 2012. So my passion for the last 11 and some odd years now has been helping people understand this concept, helping them implement this concept, and just really trying to put the word out there that there are these alternatives. It's not a fit for everyone, but where it is a fit, it's a really good fit. And so that's my passion, is just sharing this concept and helping people understand it and implement it.
Fantastic. Well, you definitely, and if you see me peeking down, I'm taking notes. So it's one of those things where
Perfect.
I don't think I'm just like staring at my phone and texting people or scrolling through Instagram. So, you brought up one, I got to say, what kind of luck you had to be in tech before 2001, and then also trying to do spec homes before the crash of 06, 07. So I'm very happy that you are doing something with your life now that seems to be working out very well, because that seems to be some painful lessons that you certainly learned in your career. But I'm very happy
For
that I
sure.
brought you to the point now, and you obviously seem happy with it. So one thing I kind of want to just kind of go over initially is that, everyone's heard of life insurance. If you haven't, then I don't know what to tell you. This is maybe a good place for you to be. So, in general, give us kind of an overview. If someone says life insurance, okay, we understand what insurance is. It's insuring against something to happen. You die, and then there's a benefit paid. But that's not exactly kind of the scope of what you're really getting into with what you mentioned of cash value life insurance and high cash value, low commission stuff, which we'll get into in a minute. But maybe give people, that are really green, really novice in this, kind of what you would say if someone said, "Hey, you're talking about life insurance. What exactly is that?" And then let's dive into kind of how it's not just you have it, you pay your premiums, you die, your spouse, your children, someone gets a big fat check that's not taxable. So let's kind of start there and then build into the avenue of saying, "Hey, here's how these things can be utilized to benefit you while you're still alive," which I think is great, because who doesn't
Hmm.
want to have some benefits while they're still above ground. So let's kind of start there, and we'll see where it goes.
You bet. So I think the kind of life insurance that most people are familiar with, excuse me, is term insurance. So term life insurance is kind of what you just described. You pay your premiums. There's a death benefit if you die, and it's for a particular term. So it could be for 10 years, 15 years, 20 years, 30 years, that kind of thing. When the term comes to an end, you're however many years older, 10 years or 15 years older, and you can then get another term policy for another period of time at, of course, a higher rate because you're now older. So that's the insurance I think most people have and that they're familiar with, is that it's on some term. You pay a premium, and if something happens, so it's catastrophe insurance, right? If you drop dead, walk out in front of a bus, whatever, then there's a death benefit that's going to come into your beneficiaries and help settle your affairs and maybe provide some lost income, that kind of thing. And that's what most people are familiar with. What people are aware of but not as familiar with is cash value life insurance. And so these would be, in my particular case, I focus on whole life insurance, which is a life insurance contract that covers you for your whole life. So however long you live, it covers you. And when you pay premiums into a whole life insurance policy, it provides the death benefit. And then there is also a cash value that builds up over time. And that cash value is something you have access to while you're still living. And what a lot of people may have heard of are the types of whole life policies where that cash value takes quite some time to build up. So it might be 10 or 12 or 15 years into that contract before those cash values build up significantly. So when we talk about the cash value life insurance policies that I just mentioned with Bank on Yourself concept, what we're doing is using some riders. I call them kind of modernized whole life, because we're using some riders where we take the premium and we divide it in the right proportions into these riders, and it builds that cash value much, much faster. Significant cash values even in the very first year. And so those cash values, as they build up in the policy, are accessible for various purposes, and we can get into more of those details as well. So
Yeah,
there's a
absolutely.
number of different kinds of cash value life insurance. Whole life is the one I focus on, but that's really the two spheres: term life insurance, or cash value, or permanent life insurance.
Okay, so just to kind of give a good compare and contrast. So your term life insurance, basically say you have a 10-year term, you pay your premiums, and if nothing happens within that period, does it just go away? Is it still in place, or do you have another policy? Kind of explain to that because I know there's different types of policies and different things happen. So does if you were to pay premiums into something like that, would again, I hate to use the word waste because if something happened, you did have that benefit. But what kind of happens to that if you just paid premiums for 10 years into a term life and then 10 years is up and you're still kicking around? What happens at that point?
Yeah, I sort of sometimes I sort of tongue in cheek would refer to term insurance as renting life insurance, right? So you're paying your premiums
Okay.
for 10 years, and at the end of the 10 years, if you're not dead, then that policy will go away. It'll stop, and so those
Okay.
premiums were the cost of offsetting that risk for those 10 years.
Gotcha. And for paying premiums like that, are those tax deductible or is it just an after tax expense you have to bear?
Uh, Generally speaking, it's going to be an after-tax expense that you have to bear.
Yikes. Okay, so let's transition. I think that's an easy enough concept for people to digest, which is good because I know insurance can get insanely complicated. I've had a few friends that have been insurance agents, and and some family members. So glad that we could at least get some simple stuff out of the way first. So the next one that you mentioned is term life, or sorry, that was term life, and then we have cash balance with whole life. Basically meaning that you are insuring, your existence for the entirety of your life. From the point that you essentially purchase that policy until you eventually the one constant in life is that we will die, the second is taxes. So we have that, and that builds up a cash value. So I think that's kind of again the meat of what we want to get into is something that builds a cash value that you can access during the time that you are still above ground. So with that said, you are going to be paying premiums for the entirety of your life. I guess that would be kind of, for the comparative, maybe the downside of it is that you are kind of entering into a contract that you have the potential to pay premiums for the rest of your life. And again, I might be hitting off the mark. I'm sure you'll explain and kind of help, bring us
Mhm.
into where this actually matters. So let's kind of explain starting off, why this again. I think the benefit is that you have access to this cash, but let's kind of get more into that of what you kind of came on here to talk about is that building a cash value that you can access. How exactly does that work? So let's start from the point that someone says, okay, this might be a better fit. What does it look like from the start of purchasing a policy like this, and then eventually getting into where you can access some of that benefit before you die?
Absolutely. So the cash value buildup in a whole life policy is it's partly a function of the actuarial calculations that go into how the policy is built, and that's extremely complicated. And I'm not going to go down that rabbit hole too much. Just know that there's some really smart math whiz actuaries that work for most of these life insurance companies that have been around for well over 100 years, and these guys kind of calculate out the costing and the risk to the insurance company of when people will die. An actuary can't tell you when you're going to die, but they can tell with uncanny accuracy when a pool of 55-year-old males who live in this area and have this kind of job, etc., what percentage of them will die when, right? They're extremely accurate with a lot of that. And so that's how they kind of build the policy. So there's a guaranteed cash value buildup that's based on that actuarial calculation. And then in addition to that, a mutual life insurance company is a company where the policy owners are actually have an ownership stake, so to speak, in the insurance company. And so when those companies perform better than expected, they pay out a dividend that goes back to the policy owners, not shareholders like they would in a stock company. So we work with mutual companies mostly. And those dividends then also, dividends are not guaranteed. So they're in addition to the guaranteed component, and because it's based on the performance of that company. But to put that in perspective, the companies I work with have paid dividends to policy owners every single year for over 100 years. One of the companies I work with was founded in 1905, and they've paid a dividend out to policy owners every year since then. So if you think about that, they've performed better than expected every year for 118 years or something like that. So phenomenally conservative companies. The dividend is not guaranteed because it's based on performance, but it's been phenomenally consistent. And so those two components is what creates that cash value buildup year over year over year. So these types of policies are going to grow by a larger amount every year for the rest of your life, no matter what you do. So the only caveat is that you have to pay your premiums. So as long as you're paying premiums, that policy is going to grow by a larger amount every single year, and there's really nothing you can do about it. So to put that in perspective, every individual is going to vary a little bit, but if I could generalize a little bit, somewhere around 70 to 80% of the premium you pay in the first year will correlate to usable cash value in the policy. And then in the next year, it gets more. In the next year, it gets more. And so usually somewhere between year 4 and 6, the amount of premium you put in the 1 year, you'll get more cash value increase than that in the policy. And somewhere between year 6 and 9, you're going to get to a point where the cash value has recovered all the premium paid to that point. And then it continues to grow from there, like I said, by a larger amount every year for the rest of your life.
Okay, so just to make sure we're getting, again, to kind of bring this into perspective, my understanding as well as anyone that might be listening is that basically with this type of life insurance policy, instead of your, premiums just kind of going into the ether, if you will, of just maintaining this policy, it actually builds up some type of tangible value within it. Call it kind of like a savings account, to lack of a better analogy, within that plan. And then further from that, so your premiums go into that, you have a benefit. So you still have, you walk out your front door and the school bus slams into you, you have a benefit that's paid. Additionally to that, if, with mutual companies kind of, to use something that we're familiar with, kind of like an ESOP, you're participating in kind of a ownership stake of the underlying entity that in turn will then pay out a dividend if there are, profits over and above a certain mark, they pay it out in accordance to what the size of the policy is, X, Y, and Z. I'm sure there's a hugely complicated formula that goes into that. But when those dividends are paid out, if you hold something like this, where it's a cash value whole life policy, is that correct? Cash value whole life?
Correct. Yes. Cash value whole life insurance.
So if you have that type of policy, the profits are paid in and help to build that cash value, or are those dividends paid out to the holder directly?
So actually the policy owner has that choice. So you can have that dividend sent to you in cash, or what we do with them when we structure these programs is we take that dividend and we buy what are called more paid up additions. That's one of the riders I was referring to earlier. And so we take that dividend, we buy additional insurance, which then correlates to more cash value.
Now, would that have the effect of increasing the policyholder's premiums as well?
It does not. It does not have anything to do with the premium. So that dividend comes in and basically the dividend acts like a premium. It buys more insurance.
Okay, so it's kind of a feedback loop, if you will, of it comes in and then you're utilizing that to, kind of, again, lack of better terms, it's paying its own premium for the additional insurance that's being bound, in the structure that you're setting up for it, in layman's terms, correct?
Yes, correct.
Okay, so we're to the point where we have, the basic framework of, here's this type of cash value whole life plan. You're paying premiums in. It's for the term of your entire life. So when you buy it till when you eventually drop dead, and it builds up an actual value. If you're invested in mutual type insurance companies, then you have additional revenues that could potentially, but typically do, come in, help to, again, bind more insurance. It kind of pays its own premium. So we're at this point. So we have something that's building up a value that can be accessed during the life of the policyholder. Now what?
So there's a couple of distinctions one that we should point out at this point. And one is that the premiums that you pay, the policy is covering you for your whole life, but that doesn't mean you have to pay the premiums for your whole life. So we can design the policy so that you pay premiums for a certain amount of time, and then you can stop paying premiums in a couple of different ways, and that policy will continue to perpetuate for life. So I want to make sure that we don't leave the impression that it covers you your whole life. You have to pay the premiums till the day you die. That is not the case. In fact, it's quite common to structure these so that somewhere around retirement age, there would be no more premiums.
Okay. Now, is that, but I'm assuming that would be kind of be a function of how long the policy's been in effect, or to just be kind of how much of it, how like, do you get to kind of choose how much of a premium you want to pay? I'm assuming there's probably scales for that. Is it kind of a choice on like how much premium you want to pay, or the term of it, or the age of it? Let's get into, because that's something I do want to kind of get into too. You talk about an insurance policy. It's like, well, if I pay it till if I live till I'm 100, that's a lot of money I'm kicking out for this.
Hmm.
Irregard of the benefit that I'm receiving, that's still a monthly bill that maybe I don't want to incur. So maybe kind of give an idea of like, how long you're paying these things for and how that looks like for how you can kind of, essentially stop paying the premium on these things.
Absolutely. So compared to other types of investments where there are oftentimes restrictions, right? To put money in an IRA or a Roth or any of these things, there are restrictions on what you can contribute. So with this tool, there are no restrictions. You can put in as much as you want, and so you hit the nail on the head when you said it. You can really put in your premium is up to you. So you, the client, really determines how much premium do I want to put in. The second distinction I was referring to a moment ago is that we have to kind of shift our thinking a little bit when we think about premiums. We started our conversation talking about term insurance and that premium really being an after-tax cost that we just have to bear. The premiums we're putting into these types of policies, we really have to think about those not so much as a cost as it is, this is money we're putting away. It's savings. It's money that's being put away. Yes, it's paying a premium for this life insurance, but it's building up this cash value. And so it's a difference between I want to put as much premium as I can, right? So I want as big a premiums as I can. And that's counterintuitive for most people because we shop for insurance looking for the lowest premium for the biggest death benefit when we've shopped for life insurance. We're kind of flipping that around. We want to put as much premium as we can afford to put in the policy to build up as large a cash value as we can for as little death benefit as the IRS says we have to buy.
Okay, that's definitely kind of an interesting thought because I would think, and again, what I'm kind of getting from this is that you're utilizing this not again for the death benefit, but for to have to build up cash values, additional assets in your life, which would again kind of help to supplant that death benefit. If you can leave enough assets and cash to your heirs, then the need to have a millions and millions of dollars of death benefit is kind of a moot point. It's kind of the game is how do we enhance our current stature in life to therefore mitigate what happens when we're gone and also increase our current position. So is that kind of a guide? Is that kind of like the principle of this is to kind of get that here now so that way the death benefit isn't as important?
Yeah, with the bank on yourself concept, most people are definitely focused on the cash value side of the equation. That's what most of us think about. However, the death benefit, as you alluded to, does create a number of advantages too. So I always encourage people not to discount the death benefit. It plays a vital role. One of the things I think about with death benefit, if we're using these cash values to make investments, and that's a distinction I always try to make, we don't compare the whole life policy to some other kind of investment or investment account. The whole life policy is a vessel that we build up a pool of cash in that we then use as a platform to go make other investments. So we use the whole life policy in conjunction with other investing strategies. It's not either or, it's both. And so one of the
Okay,
things
yeah,
I think
and I kind
about
of assumed as
yeah. One of the things I think about with the death benefit is if I pull $200,000 out of a policy to make an investment, whether that's real estate or whatever investment I'm into, if something happens to me and I die before that investment completes, the death benefit is sitting back here that's going to come in and complete that for me, right? So that my heirs, my family, they have this lump sum that then comes in and delivers what that investment was going to do to begin with, and help. So it kind of self completes. That's one of the ways I look at it. But that death benefit also plays a role with estate planning, with income replacement for the spouse that survives. A lot of things like that come into play too.
Yeah, and I would assume, and I think this is kind of again the trajectory that we're saying. So let's say you had pulled money out, and we're definitely going to kind of hopscotching a little bit, but to the point of saying that, let's say you had pulled it out and you had purchased, let's say, taken that 200,000 out, purchased, let's say, two rental homes, and they still had outstanding balances on the mortgage. Then, the death benefit comes in. Then your heirs, again, they get that death benefit typically tax free, right?
Correct. Yeah, in most
Yeah,
cases.
and then they can either, help to, let's say the, mortgage payments, a little bit over what their, their debt servicing is, they can pay that down, then have the investments come to fruition with that death benefit, and then now they have assets that they have that are cash flowing or X, Y, and Z to kind of help complete that kind of, when you're gone benefit to your heirs that, keep them solvent after you're gone. Is that kind of painting with a broad brush?
Yeah, exactly. Yep, I think you've got
Okay.
it.
So, we've kind of, again, alluded to this whole thing of getting money out of a insurance policy while you're still living. And the concept for most people thinking it's like, well, typically insurance doesn't pay out unless something happens. I have homeowners insurance on my property, but if I want a new roof, something has to damage it, or like I have health
Hmm.
insurance, I have to get sick or, break my arm for them to pay something. So I incurred an expense and that's what it's there for. So let's get into again utilizing this type of cash value policy and kind of the other caveats that we've gone into. What's it look like to get money out of it, and how does that work from the perspective of like functionally how does that work, how does it work from a taxation standpoint, because money, the government always wants to get their hands on it somehow.
For
Like,
sure.
how does that kind of work with getting money out to do these kind of investments, specifically things like real estate, while you're still living? That's kind of, I think, the crux of what we want to talk about.
Absolutely. And so the unique feature here with these life insurance contracts are that we can there's two ways to get money out of the policy. So one way is we can surrender a portion of the policy, which is kind of like taking a withdrawal. We can just take money out and use it. These policies grow tax deferred, and we can pull up to our basis with no tax consequence. So essentially, we're going to be taxed on any gains that we pull out if we do a surrender or a withdrawal. That would be a rare thing. We rarely would suggest that for someone. The way that most of us are going to access the cash values in the policy is through what are called policy loans. So life insurance companies are highly regulated in what they can invest in. They invest in things like highly rated bonds, highly rated mortgages, those kinds of things, amongst an other basket of things. But that's the bulk of it. And one of the things that they can invest in are policy loans to their own policy owners. That's obviously considered a pretty safe investment for them. And so what's happening is the life insurance company will loan me as the policy owner up to about 90% of the cash value in my policy at any given time. And what they're doing is they're using the cash value in my policy as the limit of what I can borrow, and they're using the death benefit of my policy as the collateral. So when I take a policy loan, I'm getting a loan from the insurance company that's using my policy as collateral for that loan. Now, there's a couple of unique features with that loan process that make this an appealing way to do things. One is that the insurance company does charge me an interest rate on that money that I'm borrowing from them, but it's a simple interest rate, and they apply it once a year to the policy values. So there's some beneficial effect there because it's simple interest, and depending on how fast I pay that loan down, I can reduce my effective rate pretty substantially. The other side of that coin is there's a feature called non-direct recognition that we're looking for. And this is where, because of that structure, where we're using the policy as collateral, the insurance company doesn't recognize the loan from your personal policy values, which means that the growth that we talked about, the actuarial guaranteed growth, and those non-guaranteed dividends continue to accrue in your cash value on your policy as if you didn't borrow the money. So in our example from before, if I pulled 200,000 out of my policy in the form of a policy loan to buy those two rental properties, my policy cash values are continuing to grow in the background while that loan's outstanding, as if that 200,000 was still there.
Okay.
So those two features combined, I can get extremely low interest rates on one hand, and on the other hand, my value, I don't give up anything in the policy by borrowing the money. It continues to grow as if it was still there.
Okay, so a couple things to look at and unpack there. So we have the policy loans, which again could be something as basic as a fee simple interest loan, P&I, pretty straightforward. And then we also have the non-direct recognition. We'll get into that in a second. But a few
Mm-hmm.
things I want to kind of unpack there is that okay, so you've built up a cash value. So basically, are you only how do they? I guess my question, trying to formulate this in my head while I'm talking, is you have a cash value which is based on the dividends paid if you're in a mutual product, and then also the premiums that you've paid in. So basically, are you only able to borrow up to the amount of your premiums that you've paid in, plus any type of additional dividends that have been paid in by the mutual company, or
So
is there a factor on like a multiple on that?
So we also have the guaranteed growth on top of the dividends. So there's a guaranteed growth factor in the cash values, and that's really an actuarial calculation over time. It gets more and more and more and more over time. The dividends are non-guaranteed and they're on top of that. So there's those two components, and of course the premium you're paying is what's creating all of this to begin with. So when you take a policy loan, you are taking it on the full value of the policy. So that would include the growth and dividends that have built up, not just your premium. But the limit of what you can borrow is that cash value. So let's say over the course of, to keep this simple, over the course of 10 years, we've put $100,000 in premium and the policy has a value of $125,000. We can borrow about 90% of that 125,000. Right?
Okay.
We've got more cash value than premium that we put in, and we can access about 90% of that in the form of a policy loan.
Okay, so when you take a loan, obviously loans are non-taxable income to you. So you take money
Mm-hmm.
out, that's not going to be a taxable event, correct?
Correct, under current tax law, yes.
Okay, so you take it out now. I'm assuming so that brings up a few things that definitely need to be covered. Is that one? I'm assuming you still have your premiums that have to be paid on the policy to keep it into effect, and then two,
Mm-hmm.
what does it look like as far as payments that have to be made on that loan? What does it look like in the event of default? What are your obligations to ensure repayment of that loan, and the like? So let's kind of get into the nuts and bolts of functionally taking that loan out, what kind of obligations is the policy holder unto, and what kind of burden on payments are there as well?
That's a great question, Alex. I'm glad we're segueing into that because that's really the third component that makes this tool unique, and that is that these are non-recourse loans. So there is actually no obligation whatsoever on the part of the policy owner to repay the loan. You technically don't ever have to repay it. Now, I always advise my clients that you should be a quote unquote honest banker, right? You should treat your borrowing functions from your policy like you would any other source of financing, any other bank or finance company, and pay your loans back. The advantage is that you have complete control over that process. So, for instance, I have clients who flip real estate. And so they'll take a policy loan from their policy to purchase a property. They may not make any payments on that loan for 6, 8, 9, 12 months. When they flip that property, they then pay the loan off in a lump sum. Perfectly fine, they can do that. I have other clients who do it differently. They take the cash flow from a rental property or from a syndication deal, and they'll apply that to the policy loan over a term. I have a client working on one right now that's a 7-year deal. He's taking the cash flow from the syndication investment, paying down the policy loan during the 7 years, and then when he gets paid out at the end of 7 years, he'll pay the remaining balance of the policy loan off, and then rinse and repeat, do it again.
Now, as far as this is kind of the minutia of strategy, but just kind of coming from my experience in real estate investing. If you weren't paying that loan down, you wouldn't be able to capture, the interest as a write-off to the profits that would potentially be born from that deal, or because it's a personal non-recourse loan, would it be a moot point anyway with being able to have an interest write-off since it's a personal loan to you and not tied to that and not encumbering that real estate? Do you know about that per se?
So that's where it's important to have your accountant involved. If you're going to be investing like this or using some of these tools this way, you want to have your accountant involved and make sure that you structure how that loan happens. So, for instance, you personally own the policy. You can make funds available to an LLC who's the lender and create some advantageous tax reporting that way. But again, I'm not a tax advisor. I don't give tax advice. That would be something for your CPA, your accountant, to help you structure based on the state and the circumstance you're in to make that effective.
Yeah, that's kind of the same answer I give most people. The broad answer of what I think you said is that it depends.
Yeah, there you go.
Talk with the tax advisor.
Yeah,
Yeah, talk with a
exactly.
tax advisor, and they can certainly hash that out for you. Now, with regard to, again, you said it's non-recourse, you're under not necessarily an obligation to repay, but if you are in what kind of term are these loans pegged on? I mean, you could essentially, if all else remaining equal, if there's no, cap on that, you could just write a, 100-year note to yourself. And if you don't make payments and and it's not recourse, you couldn't be technically in violation. But, with any note, there's going to be terms to it. So, if you don't make payments, does the lender have the ability to call the note? If you're not making payments, obviously you're in violation of the term agreement of that note. So, what obviously you should, and I kind of agree with you, practice good faith when doing things. If you agree to
Yes.
repay the money, you should probably repay the money. So what does that look like? Are you paying a lot of penalties when you repay if you hadn't made payments on the note, if you took it out to do investments, or the like?
No, not at all. So there, first of all, there's really no note. There's no qualifying. There's no application. When so you have a policy. You call the insurance company up, and or you call me, your agent, or whoever, and you go, hey, I'd like to pull a policy loan. How do I qualify? They're going to look and they go, yep, you have a policy. It has cash value in it. You qualify. That's it. That's the only qualification. Well, great. How much can I borrow? Well, you can borrow 90% of the amount of cash value you have. Okay, perfect. They're going to send you a form. You're going to sign the form, and they're going to direct deposit the loan proceeds within about a week. I mean, it's that simple.
Okay.
Okay. So the repayment is entirely up to the policy owner. So we can, what I do with my clients is I talk to them about how their situation is, and I run the numbers for them and say, okay, if you pay it off over 5 years, this is how much you're going to need to pay on a monthly or annual basis, and this is how the interest scenario is going to work out. And then I'll also pull their, like the gentleman I mentioned that has the syndication deal he's working on, we pull the investment projections into it, and I can plot all that out for them on exactly what this is gonna work out to be. And so they may come back and say, well, I don't really need to pay it in 5 years. Let's do it in 10 years, and I can run the numbers that way. So you're right. They could give themselves a 100-year note, or the equivalent of a 100-year note, and just never pay it off. Now there is a risk to that, and it's very important that we talk about this risk. And that is, if we don't pay anything against the loan ever, the interest is going to get capitalized into that balance year after year after year after year after year. And there will come a point where the loan balance will exceed the cash value balance. Now, in most cases, unless it's a very large amount, that will take many, many, many years. But when that happens, the insurance company has a legal obligation to terminate that policy. They cancel it. And the IRS is going to determine that all that loan money and all the growth in that policy over those years that it took for it to finally lapse was all a taxable event. So there's a giant tax bill coming, right? So that's the risk, and why it's super important to pay the loans back. And, because that can bite you on the tax side if you're not responsible and you don't pay those loans back. The exception to that is that we do take these cash values when someone's ready to retire and convert them to passive income streams. So we take this cash value and essentially annuitize the cash value into an income stream, and we plot those income streams to last well beyond age 100, so that effectively, and these are the only time we don't pay loans back. So we use that surrender or that withdrawal up to the basis, and then we switch to loans and continue to pull that income stream out, with the idea being that ultimately the death benefit will eliminate that loan after someone passes.
Okay, gotcha. Yeah, that kind of definitely brings that more full circle on how that death benefit can be used. Now, to the point of, keeping a policy in good standing, 'cause I think you mentioned, if the policy is terminated, then you have things like the value of the policy plus any outstanding loans could become, potentially taxable event to the policyholder. So in that, scenario, we have this cash balance, we've borrowed against it, we've done X, Y, Z, we're doing that kind of stuff. But let's say something happens and you can't make the premium payment. What happens in that scenario?
So if you can't make a premium payment, there's a number of things that can be done within the policy. I mentioned that there's a point where you can stop paying premium. And so there's a status we can give the policy where they'll reduce the death benefit substantially and no more premiums are due ever. You can't, now that also means you can't put premium in ever. So you can't start it back up again. Once you do this, then that policy is, but the policy will stay in force and it'll continue to grow and it'll do all the things that you can borrow against it, etc., for the rest of your life. So there's that scenario. Another scenario that's quite common is usually when someone can't pay a premium, it's temporary, right? They lost a source of income, they've had something happen that put them in a financial situation where they can't pay premium. And so in that case, we can actually pay the minimum premium out of the cash value in the policy. We can offset the cash value in the policy to cover the premium. So, I've had situations where maybe 2 years they can't make the premium. And so for 2 years, they use the cash value in the policy either as a loan or a surrender to cover those minimum premiums. And then they pay those loans back once they're back on their feet and they get back on track, in the third year. So there's a lot of different ways we can have flexibility with those premium payments.
Gotcha. But would it be the case if you had borrowed, let's say, the 90% of the cash value of the plan, would that also affect the ability to use that cash value to pay premiums?
It would, to the extent that there's not enough cash value left to pay the premiums.
Okay.
So,
gotcha.
So, and the other thing too is with the way the policies are structured. Let's say somebody sets it up and they have a $24,000 a year maximum premium that they're putting into their policy. The minimum premium in that scenario is probably something like $4,000 or $5,000 a year. So we have a lot of situations where maybe I can't hit the 24,000 this year, but the minimum 4,000 is not a problem. And we can just pay that minimum amount and then pick up again when we have the money later.
Sounds good. Great. So this has been fascinating, but unfortunately we're kind of coming up towards the end of our time. So, the focus is, again, and I want to make sure we get any coherent points on the aspects of the, pulling this out. I think we've kind of covered the functionality of getting it out of a plan to be able to do these investments. Now, specifically, again, your ability to pull the cash out while you're still living and then be able to plug it into investments. Now, once let's say you have, again, borrowed that money, you continue to make your premium payments, can you build up additional cash value in the plan to take another note or amend that note, or are you under the obligation to only take out at one chunk at a time?
Yeah, the repayment on the policy loan works like a revolving account. So every payment you make against the loan frees up an equal amount of cash value again. So you can have multiple loans simultaneously up to the limit of your cash value amount. And I think one of the key points with doing this for investments, and the reason I describe this as not comparing it to an investment, it's something you use with investments, is that you're building up the equity in the policy. You can borrow the money and that equity continues to build at the same pace that it would have. And then on the other side, you've got the investment and you're building up whatever profit, whatever equity you've got in that investment. And so you're getting the combination of the two at the end of the day. The equity in the policy is kind of this modest growth. It's plodding along year after year after year, getting stronger and stronger. And then you're using that to go make this investment over here where, you make a great return, you make great profit. And at the end of the process, you've got both the equity in the policy that's built up plus the equity in the investment. So it really just enhances any investment that you're going to make.
Yeah, and I'm assuming, kind of to go back to the issues I said with paying premiums, when you set these plans, you can kind of tailor that out. And I'm assuming working with someone like you kind of have a a very realistic goal. It's like saying, hey, look, here's what the maximal thing that we can put in here, but I'm a very conservative. For being 34, I'm like I should have way more gray hair than how conservative I am. But it's of looking at it, you can say, okay, I really want to make sure if anything hits the fan, we're really tight on this. I want to have my minimum premium be, let's say, $1,000 or $3,000 a year. So that way I can say, if I'm, basically just paying my mortgage and light bill, I can still afford to have this benefit there. When I finally get back on my feet, we can have, the upside of how much I want to pay. But these things are highly customizable. Is that a fair assessment?
Extremely customizable. Everyone is customized to each individual.
Yeah, and I think that's the good thing to kind of take away from this. And then additionally, are you under an obligation, let's say, so I'm assuming that the terms of these things can't really be modified too much. If you say, hey, I have it, here's my minimum, here's my maximum, can you modify that in the future? Or could you would have another policy that you create to then in turn maybe have a bigger one if let's say you really get in the swing of your career, you're making good investments and you want to have additional benefits from stuff like this. Can you have multiple policies?
Yes, and that's you're exactly right. Once you establish that maximum amount, you can't exceed that in any given year. So that if you wanted
Yep.
to exceed that, then you would set up another policy. I know people who have upwards of 30 policies. They've been doing this for decades, and they just keep
Yeah.
opening new policies. So yeah, obviously there's a limit to the amount of death benefit that an insurance company will issue on a single life. That limit is usually
Yeah.
quite high for most people. But that's really the only limitation is the amount of death benefit.
Okay, great. So just to kind of bring this in for a landing, and I'm sure we could go on for a very long time on this, is that the big thing that we're talking about on these types of policies would be a whole life with a with a cash value component to it. That when you invest these kind of things within certain types of companies, especially mutual companies that underwrite these policies, you have additional kickers that are going to pay in as kind of like an ESOP of profits to these things. The components of borrowing against these are very analogous to what you'd look like with a retirement plan, on that you can borrow up to a certain ratio of money from them, like a 401k. Those things are typically, again, check with your tax accountant, non-taxable.
Mm-hmm.
You can utilize those things in order to make other alternative investments. Mainly, kind of what you focus on is real estate or real estate adjacent investments, tangible hard assets. These being non-recourse loans, you're under no obligation to repay them, but again, just like you and I agree, go in good faith, repay these things. The benefit to repaying these things is probably going to outweigh not repaying them in the long
By
run.
far, by far.
And again, that kind of painting with a broad brush, I think that's very interesting. And especially, although this doesn't hit on something that could be an asset of an IRA, it definitely helps to kind of illustrate how you can get additional money to make, tangible hard asset, and again, I hate the term alternative assets, but alternative asset investments, with things personally, and help you get more cash than you otherwise might think is available to you just by working a 9 to 5, saving in your retirement plan, again, to help augment that and give you additional benefits, while you're still alive. Anything that you want to add as a capstone to this?
There is one last thing that I would add, and that is who you
Sure.
work with. The person you work with to set this up for you is extremely important. What happens sometimes is people will hear about the concept and they'll run down to any insurance person they know, and that person will often say, "Sure, I can do that." But if these policies aren't structured with the right riders and they aren't structured in the right proportions, they can become what's called a modified endowment contract, a MEC, and that will wipe out most of the tax advantages in the policy. And so, unfortunately, I've seen this too many times where someone will interact with me and say, "Yeah, I've got one of those policies," and then they send me over the statement, and I look at it, and well, unfortunately, it wasn't structured correctly. And so it's really important to work with an agent that has the training and the experience to structure these policies so that they work the way that we've been talking about today, because it
Great.
can be set up incorrectly. And so, seek out an agent that really knows what they're doing. Of course, I'm happy to work with anybody that would like to find out more about this.
Fantastic. Well, I would highly encourage, if I am I like to think myself very knowledgeable in many things, but I am definitely kind of in the group of people learning things today. So if people want to get in touch with you to learn more about this, pretty fascinating topic, I feel, how can they get in touch with you? Where can people find you to kind of learn more about this?
Yeah, if people are intrigued by this and think this might be a good fit in their life, and like I said at the very beginning, it's not a fit for everyone. I often kind of joke that it'll work for anyone, but it's certainly not for everyone. The best thing to do is just have a conversation and find out a little more about whether it's a fit. So I've set up a landing page. It's called Jump On with John. That's JOHN, John. JumpOnWithJohn.com. And you can grab a free 20-30 minute strategy session with me. It's just a conversation to find out a little more about you and a little more about how this works, and start that process of finding out if this is a fit for you. So that's the best recommendation I can make, is just have a conversation, no obligation, no pressure, just a conversation at jumponwithjohn.com.
All right, fantastic, John. I really appreciate you being on with us today. You were certainly a wealth of knowledge on this topic, and I always enjoy these conversations when I get to learn something. I had another great podcast this week about the ins and outs of investing in how industrial real estate syndications are set up for heavy industrial manufacturing buildings. So I got to learn a lot this week. I learned about life insurance, industrial real estate. So one of the benefits of hosting this podcast is getting to talk to subject matter experts like yourself. Again, my name is Alex Perny. This has been the Alternative Investing Advantage podcast. I want to thank our guest, John Ensley, for being on with us today. Please do check him out if you want to get more information on this topic at hand. Thank you very much for joining, and we'll see you on the next one.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.